Hello everyone, my name is Zhao Zhiya. Today we are going to talk about Revenue Group PhD. Our group member is Lin Xiaosha and me. Introduction. Founded in 2003, Revenue Group Berhad is a prominent player in Malaysia's electric payment industry with over 15 years of operational history. The company is listed on the main market of Bursa Malaysia and specializes in providing end-to-end payment solutions to diverse clients, including banks, no-bank institutions, physical and online merchants, and e-money payment scams. Its registered office is located in Kuala Lumpur, with core operations focused on technology-driven payment, infrastructure, and digital solutions. Core business segments. First is electric data capture terminals, distributions, deployment and maintenance of payments terminals for physical merchants. Second is electric transaction processing, service as an acquirer, master merchant or third-party payment processors for credit cards, debit cards, and e-money scams. Third is payment infrastructure solutions, includes payment gateway services, network security. Next, I'm going to introduce the corporate structures. Revenue Harvest Berhad focused on EDC terminals and payment processing, while Holdings Berhad specializes in ID verification technologies for eKYC, anti-fraud processes, and mobile biometrics. EPPA SDN PhD engaged in e-commerce and digital payment app development. Revenue Skill Berhad provides secured card insurance technology and encryption services. Mission, vision, and values. The core values of the corporate is commitment, delivering customized solutions via internal R&D, including AI-driven advertising and loyalty programs. Second is transparency, fostering open communication with stakeholders. Third is trust and integrity, building relationships through reliable service and delivery. Here I'm going to introduce questions. For the Holding Berhad, we can see that it holds 51% of interest and it is simple equity based on questions, while for EPPA Berhad holds 70% of interest. It is no complex capital structure reported. For Revenue Skill Berhad is 100% of interest. It is simple equity structures as well. Holding Berhad date of acquisition is during 15 months period, ending on the 30th September 2023, and it holds 51% of interest. Its capital structure in the annual report does not indicate a complex capital structure for these acquisitions. The acquisition is mainly through equity investment, and acquired company's capital structure is relatively straightforward, with no special convertible instrument or preferred shares that would complicate the ownership calculations. For EPPA Berhad, date of acquired, not clearly specified in the overview for the 2023 annual report period, but the company holds a 70% stakes. For the Revenue Skill Berhad, date of acquired also not clearly stated in the annual report, but it holds the 4 ownerships. Capital structure is also the simple equity structures, no complex instruments reported. Now, comparison with applicable accounting standards. Recognition of acquisitions. MFRS 3 requires acquisition date must be on the date which the acquirer obtains control. For Revenue Group Berhad, if the company can clearly determine the disclosure of the exact date when control is transferred for each acquisition, complies with the standard. However, a lack of specific date in the overview may be a minimal deficiency in disclosures. For associated and joint ventures, since there is no relevant disclosures, if there are any such investment, it would be a no compliance.
So now let's make a deep analysis of the report. In the report, it disclosed the complex group structures in detail. It lists all the direct and indirect subsidiaries like this by ownership percentage and the principal activities. And the complex structure is fully transparent. And now let's look at the determination of the goodwill on the merger of subsidiary in the revenue group ahead. From MFRS 3 business combination, it requires the disclosure of the nature and financial effect of business combinations, which should include calculation of goodwill, asset and liability recognized, and the factors that make up goodwill. So according to the financial position as at September 30, 2023, we can see that there's a substantial increase by around 34.3 million ringgit from 10 million to 45 million in goodwill from 2022 to 2023, and which signals there's significant subsidiary acquisitions. And these are the three major acquisitions during the financial year, which disclosed in the report. As for goodwill calculation from business combination, in Note A it is disclosed that the cash paid for fair value of consideration transferred is 43 million ringgit, and the measured NCI as shares of net asset is 11.3 million ringgit, and the net identifiable assets are 23.9 million ringgit. So the arising goodwill from business combination is 30.3 million ringgit, and in this 13.5 million ringgit in goodwill, which is specifically from the extensive acquisition as a part of the innovative deal. And the total goodwill of the 45 million ringgit, which we mentioned just now, is allocated to the two kinds of CGUS, which is EDC terminals, and it allocate the 2 million ringgit. Another thing is the solutions and services, which including the innovative and extended, which is 43 million ringgit. So in the report, we can see the disclosure of the purchase price allocation is detailed. It shows all the significant asset and liabilities at fair value, and the NCI is measured using the proportionate share of net assets, and the amount is also disclosed. As for the goodwill calculation, it is explicit and reconciled to the financial statement, and the impact of acquisition on the group revenue and the profit is also disclosed. But there are also some points that the company could do better. They can disclose the effect of contingent considerations, if any, but it wasn't mentioned in the report. So as for the impairment loss, the total impairment loss for the year was 9 million ringgit, and this relates to the goodwill allocated to the specific underperforming subsidiaries like Buy More Services, Sendirian Berhad, Revenue Commerce Sendirian Berhad, and others. And this CGUS failed their impairment tests, and their recoverable amount was lower than their carrying amount, so the goodwill was impaired accordingly. So the report disclosed which CGUS was impaired and the amount written off, and the key assumptions and the rates used in impairment testing is also disclosed. And it also disclosed the fact that the goodwill and tangibles are not amortized but tested for impairment. And also the method for calculating recoverable amounts to and the sensitive to key assumptions is also disclosed. So as for the impairment loss, the company could enhance disclosure by the detailing the event or circumstance that trigger the impairment, and they can show a more granular movement schedule of goodwill by each subsidiary or CGU. So, a little summary. The report of revenue group Bahar is compliant with MFRS in these aspects highly. One of these for reconciliation of consideration assets, liabilities, NCI, and goodwill, and allocation of goodwill by CGU tested for impairment and impairment losses recognized as needed, and the disclosure of the impact on group revenue or profit if acquired subsidiaries had been from period started. But there's also some weakness. Um, for example, its lack of a dedicated note on each material acquisition with a full purchase price allocation, qualitative and quantitative disclosure of the goodwill, and also the supporting details on NCI and impairment. And the company could also disclose the specific event that caused the impairment loss. This would bring the report into full alignment with MFRS and can also improve users' understanding. As for the intercompany transactions in the Note 3, it mentioned that intercompany transactions, balances, and unrealized gains or loss on transactions between group and companies are eliminated. The unrealized losses are eliminated only if there's no indication of the impairment. So with the disclosure of intercompany balance, we can see that the amount due from subsidiary companies as at 30 September 2023 is 49 million ringgit. And these are the unsecured, non-interest bearing and repairable on demand, and the impairment allowance for intercompany balances at July 1st, 2023 is 1 million ringgit, and there's no new impairment recognized during 2023. So the balances are disclosed in the company's account as required with the MFRS and fully eliminated in group accounts, and the impairment allowance is also transparent. So as for the recommendation, the revenue group Bahar's reporting and the disclosures on transactions between companies in a group are fully compliant with MFRS, and intergroup balances and transactions are eliminated in the consolidated financial statements, which we can see from the notes and reference above, and the impairment allowance on group balances is also presented, but there's only the company level balances are disclosed with specific amount, and it could be a table include the total amount of intercompany revenue and expenses eliminated, and the total intergroup dividends eliminated, and the total intergroup balances eliminated on consolidation. And there's also no the breakdown of material balances or transactions by subsidiary. If any subsidiary account is a significant portion of intercompany transactions or balances, the company could list the major subsidiaries and the respective amounts due to or due from the parent or between the major subsidiary, which could add user value. And that's all for our presentation. Thank you.